Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is May 15th, Thursday, and I'm sitting here in New York City with a live recording. I'm here in the offices of MDRC, and here watching this audience, we includes John Cheshire, who works with Clearbrook Global, and that is a consulting firm. So as we go through some of the slides, we'll ask John for some of his insights and look forward to hearing that. So let's move on, and I'm going to share the slides. So this is live from New York, and I've called this May 15th, is it all a fever dream? At this moment, we are at a stage where we're wondering whether all that passed in the time since Liberation Day at the beginning of April did in fact happen, as in many cases we have retrenched and retraced our steps and gone back to the beginning. So some have suggested it's akin to a dream that never actually happened. Although, as I'll suggest later, there have been some longer term implications of the uncertainty that has been seeded here since this period. And even though it seems that, at least in market terms, some of the ground has been made up, I would suggest that we're actually at a phase where we are going to likely continue to see the repercussions of this for some time to come. So as usual, I'm going to go through the five fingers of the hand of inflation, interest rates, equity markets, geopolitics, and other asset classes. And in the case of this week, we have had news about planes, trains, and automobiles over the course of the week. And the plane is the now infamous 747 that may be delivered to the US administration from Qatar. The so-called Palace in the Sky has been the subject of some consternation on both sides of the aisle, and no market implications yet. But the recent trip by the president to the Middle East has led to some announcements around investment, including in Boeing. And we'll see if that has any repercussions later. There's also been some rumblings in geopolitics around the Middle East on terms of that have affected the oil price. So we'll come to that. When it comes to trains, we did have 3 leaders of Europe on a train from Ukraine, where they'd had a meeting with Vladimir Zelensky. That is still, the peace talks there are still in full throes of discussion. So geopolitics there. And when it comes to automobiles, that would be the reference to China. And this time last week, we were hearing about progress made in the US-China trade negotiations. Automobiles don't really come under that, but it was my way of having a catchy catchphrase. We have had a turbulent round trip for markets. We'll talk about that. We've also had the first indication of a tax bill, a beautiful tax bill, which we can talk about whether that continues to exist in its current form or not. We'll move to that. And then, as always, we will ask where we go from here. So let's start by talking about inflation. It seems that some of the inflation worry has abated now, that we see that if we look at the current recent inflation numbers, they have generally been quite subdued. In fact, the actual CPI month on month at 0.2%, down from an estimate of 0.3%, and on a year 2.3 versus 2.4. The really interesting factor about inflation right now is that services have driven inflation for some time, and services are quite loosely connected to tariffs, but not directly. We don't have the cost of goods driving that as we would have with tariffs. With good inflation, we can see that food has been a modest contribution to inflation. Services have continued to be strong, but the price rises there are slowing. So that is giving confidence that some of the inflation trajectory we're seeing is likely to be sustained. When it comes to other aspects of the recent inflationary numbers, we can see that CPI changes have all been quite modest. Whether we take food and energy out, leave it in, overall, in particular, the changes in services, that's been the smallest gain in 4 years. So this is all now starting to mirror the experience around inflation that we've seen in Europe, in the UK. This has given confidence to those central banks to start their monetary easing apace. It has still been something that's been observed closely by the Fed, and I'll speak a little later about the Fed in terms of their movements. But so far, inflation at least seems to be behaving as you would expect it to behave. The issue is where we go from here. And at this point, it's safe to say that none of the tariffs that have been announced since Liberation Day, even though there may be a stay on them, have really come into effect through price increases. There has been a suggestion that there was a softer than expected inflation, points to muted tariff fallout. I'd say that's temporary. And when it comes to whether or not there will be prices pushed through, I'd say again there, Walmart is the biggest retailer to pass through, will be passing through tariff price increases. We know that Walmart operates at the lower end, perhaps of the cost spectrum, again, it will be socioeconomically, this will be disproportionately felt by lower earners, blue collar workers at the lower end of the spectrum in terms of earning power, so that it is likely to hurt that consumer. I'd love to just turn to John here and ask, in terms of the inflation figures, whether that's something that gives you comfort when you see a number like that, in terms of a top line 2.3, or are you concerned about the potential impact of tariffs?
I think that we have yet to see the full impact of tariffs, and likely that will play out over the coming months. We expect to see higher inflation across the board.
Yeah. And if that's the case, and taking that to its natural conclusion, higher inflation would naturally put a stay on the Fed's any attempts to lower rates, which it seems the expectations have even come in quite a bit.
For the most part, yeah, I think it's between 1 and 2 cuts towards the end of this year, potentially, the market's expecting, but we'll see whether that happens or not.
So I suppose there wasn't much reaction to that CPI number, probably because it was a positive one. It wasn't a negative reaction, and it certainly gave more confidence around the Fed's direction. But I will say that this is now something that I think we have to really factor in. So the fact that there have been no tariffs, there's been a shift in expectations around rate cuts. We have seen quite a bit of volatility around rate cut expectations when we, even if we look over the course of the year, it has moved quite a bit from December through with June and September. If you look at the rate cuts coming forward, I'd say that markets have gone from believing there'd be no cuts to the tariff world where they thought there would be 3 cuts, to back now, and it seems tariffs are, I wouldn't say they're off the table. I mean, I think it's an exaggeration to say they're off the table, but certainly muted tariffs, there'll be fewer rate cuts. However, the bond bears, I think, when it comes to rate cuts, would agree with that, and have been pushing the 10-year as well as the 30-year up. And we've seen that the 10-year now approaching over 4.4%, and then the 30-year close to 5%. So clearly we're at a point where the bond market is not is second guessing perhaps any idea around certainly the fiscal situation. Would you say the bond market has got it right so far?
So far, yes, and they're still pricing in a lot of uncertainty.
I thought this was quite interesting. There was a bit of analysis around the Fed's recent press conference, and a suggestion around it having a new framework to work with, and how that might translate into the Fed's own the priorities. And I think this is important. It's worth spending a little bit of time. For those not looking at the screen, there's a few more words here than perhaps I could read through. But I'd say it was safe to say that we have to back up a little bit and think about the role of the Fed. The Fed has struggled to, I think, regain the confidence of investors, appear to be the adult in the room when it comes to setting policy, maintain its independence, and not fall into the same traps that it had fallen into before, when it suggested that inflation was transitory, or in other cases that it had been too late to cut rates. So it was very strident and confident in its rate rise cycle, and has been quite restrained, certainly relative to around the world, in terms of this new easing cycle on the other side, or coming down the mountain in terms of that. I thought it was interesting to see that they are slightly shifting, and they're reflecting the fact that inflation has changed its shape. What the Fed seem to be saying now is that certainly that low rates are not a sure thing. We've heard some commentators this week speak about higher for longer, not lower for longer, when higher for longer, and that certainly seems to be the Fed's preferred approach. But it does seem that they're now looking at this inflation as at having more volatility going forward. They speak about supply shocks, and certainly, whereas monetary policy can affect demand, which could affect inflation, the supply shocks such as we've seen for COVID, such as we're seeing around tariffs, that is much more difficult to predict, and I think more difficult to suggest how long it will affect inflation. And even the movements in the oil price are akin to a supply shock. So it's interesting that they are now reflecting possibility, higher real interest rates reflect the possibility that inflation could be more volatile going forward than in the inter-crisis period around in the 2010s. And we may be entering a period of more frequent and potentially more persistent supply shocks, which is a difficult challenge for the economy and for central banks. And however, they're not straying from having a 2% inflation target, but it may be that they're just simply not able to bank on inflation staying low. They have to build in some buffer for that. I thought the other interesting comment on the Fed was that the confidence in the Fed that has been rebuilt is almost self-fulfilling, because there is a sense that there's the public believes the central bank will keep inflation low. So when the public has that confidence in the Fed, in its ability to focus on inflation and not do anything that's irrational that might lead to a spike in inflation, that confidence actually will filter through the economy and will lead them to behave in a more kind of more balanced fashion.
I would add that I think that they are operating with the same degree of uncertainty that we all are, and we don't know whether tariffs or a shift in geopolitical action by our current administration could impact any decisions that they make. So I would have a tendency to think they're going to wait a little bit longer than one would hope before they do lower. We are already operating with, even though there's been somewhat of a reprieve with tariffs, we're still operating at a level that we haven't really seen since mid 20th century.
So, in terms of tariffs.
In terms of tariffs.
Yeah, exactly. So the idea that they're off the table or sort of obliterated is probably a miss. Yeah,
it's a pause.
A pause. Yeah. And I'd say the other thing when we talk about market conditions, it is a pause that is actually it seems to be not well thought through with markets, and certainly it has not been. No detail has been provided when it comes to these, whether it be the UK-US trade negotiations or the US-China trade negotiations. No detail was there. So it does certainly seem as if there's the markets are shooting first and asking questions later on the upside.
Very much so. Yeah. I mean, typically trade agreements take upwards of anywhere from 18 months to 2 years to be finalized, and we're expecting to do this in a matter of days. So I think that the uncertainty is warranted.
Maybe it's the AI contagion. We think that everything's going to be quicker, faster than before. And just before moving on to markets, it is worth reminding the listeners of what is going on in the rest of the world regarding bank rates. We know the Bank of England has cut its rate for the 4th time. ECB has been on 7 rate cuts. They are coming down the mountain. They are trying to avert stagflation. And the Bank of England at least signaled that there would be more rate cuts coming there. So clearly more confidence in their inflation being at least in some form of check. So as the Fed stands alone, this may be provide some upward support for the dollar if the rate tends to be higher. But as we'll show later, there has still been more of a systemic selling of the dollar, probably reflecting that same uncertainty that seems to be affecting everyone. I think for every action, there's an equal and opposite reaction. As we've seen these rates come down in Europe, as shown here, there's now been an interest in US companies borrowing in Europe and entering the US market. We're hearing issuance exceeding 40 billion, thanks to lower borrowing costs and the opportunity to diversify funding sources. And this is an important concept, diversifying funding sources, that every country needs to think about and hold dear. But I would say that this is a very positive development. US companies seeking to issue in Europe, I think it will add depth and liquidity to the European market. We've also seen a demand for German bonds as a safety trade versus, say, the US Treasuries. So I'd say just more action in Europe, a deeper market there, more activity is healthy all around. So to equity markets, it's been a very difficult time to give any clear read. The positive thing is that we are now positive on the year in terms of the S&P. We wiped out 2025 losses. So not only have we rebounded since Liberation Day, we've essentially kind of done a round trip since the beginning of the year. And the size of this rebound, it's worth analyzing, although I don't like to predict anything from that. It started, the last time it rebounded in this fashion was since 1982. It was in 1982, which was at that time the start of a great bull market. I don't think we're dealing with the same start of a bull market phenomenon right now, but it is notable that if it feels to listeners that it has been a very volatile and sudden run up, it's because it is, and it is exactly it has been. And just back to this idea that this is not grounded in fundamentals. I mean, we've both seen a fair number of cycles, and at times markets do seem like they depart from fundamentals, but it seems to be particularly ready to act on news and almost rumor at this point. And we also know that retail investors are active, and they've been putting money into the equity markets in the US when institutions have been leaving or at least diversifying globally. Do you have any sense as to whether this could end in tears in terms of the just that these type of flows?
I think the retail environment has a pretty significant confidence in buy the dips. I'm not sure whether that will transcend to the institutional markets. And frankly, there's so much uncertainty there now that I'm not sure whether that's a smart move to buy the dip at the moment.
Yeah.
Yeah.
Yeah, we'd agree. Certainly very difficult to do that. And I'd say just some examples just of something like healthcare, which actually up to now was seeing reasonably decent inflows. It was really more of the balanced portfolio. We saw inflows. I have a chart here showing into tech, into healthcare, which was above the 4-week average. Tech and healthcare were at the top of the sector index in terms of flows. Utilities seeing outflows, utilities being a rather mundane sector, perhaps in comparison to tech. Healthcare traditionally been seen as more of a defensive sector and a good hedge against, say, a tech boom, is more of a value play in some cases. But healthcare has taken quite a big hit recently. One of the massive blows has been the announcement by executive order around drug pricing just this week, which did strike some as a little unexpected, more of a populist move, perhaps unexpected because it kind of flew in the face of what has been that dance that has been done with lobbyists in the pharmaceutical industry up to now. The other issue is certain key names. We've spoken about United Health before, having had a 20 plus negative performance in the aftermath of its earnings. Now we hear that it has had a change of CEO and is under criminal investigation for possible Medicare fraud. So more tarnishment, I'd say, of some of the healthcare insurers. And finally, when it comes to obesity drugs, that has been the shining light around healthcare. And we've seen a switch from injection to tablet form, which gave them a little bit of a boost. But it seems that there is overall not much inspiration, to use the term for one of these charts, around healthcare, and it has been taken a hit. So this will affect client portfolios because we're looking at a segment which shouldn't be shorn up in usually against some kind of a recession, but it seems to be taking a hit maybe because of these left field assaults such as drug pricing.
Well, I also think that there may be some changes at the federal level in terms of how we view our healthcare. We're waiting for a paper. I believe it's going to be released this week from Health and Human Services, and there may be some pushback with respect to what types of foods we eat and what types of medicines we take. So I'm sure there's some of that flowing into that space as well.
Continuing theme of uncertainty. Certainly uncertainty across the board, and that is not just affecting the other sectors. Let's turn to the tax bill. It's early days. We don't know how this will actually be ironed out, but I think it's important to look at what this bill does not do. And this bill does not solve the federal deficit problem. If we look at the statistics here, the federal deficit is the deepest in history outside recessions. So we're still dealing with a pretty difficult starting point. And then when we look at these current tax cuts, many of which are in this new bill, we can see that 75% of investors expect US tax cuts to increase the deficit. So that's 75% of investors can do basic math and can see that when you have one side of the ledger is not equaling the other side, you're likely to be getting further into the red here. So this is early days for the tax bill. It's not even worth parsing it a great deal because it probably will look different. But suffice to say, this will do nothing for those the bond hawks, or the bond vigilantes essentially, who were concerned about lack of fiscal prudence, and it probably will not be good either for those who see U.S. assets as a safe haven. You've had some interesting. You suggest that this bill also has factored in tariff revenue, which may not materialize.
That was originally supposed to be part of the big beautiful bill. Was roughly $2 trillion in tax revenue that we received from the tariffs. So keep that in mind that the deficit may increase more as a result. Also keep in mind that we need to get this wrapped up. It doesn't necessarily have to be wrapped up by the end of the year, but we do have a revision in our debt ceiling come August, which is going to place greater pressure on getting this done. So.
And again, it's a bit of this short-term, long-term trade-off, because the short-term wins around tax cuts, and certainly that was behind the momentum going back to November. Post-election momentum was all around this pro-business and generally positive deregulatory environment that was coming, and a lower tax regime. So that I'd say that froth has been carrying markets for some time. I'm not sure whether this has been discounted in or whether it will be used as a positive soundbite to offset some of the negative uncertainty that we've seen before. But equally, long term, this does not fix the problem. It only accentuates it. So whether we've got that long term, short term trade off, again, markets have been trading on very short term information. So I think it's important to factor that in. Geopolitics continue to be colorful. I mentioned at the beginning the planes aspect of the Qatar. Clearly, the offset to as part of that trip, ordering 210 Boeing jets. Positive news. We've also seen comments around an Iran deal come out of the presidency, and that has led to the oil price sliding. So that's again positive for the inflation numbers. Although if last week's chart persists, a chart I showed last week and the week before, there doesn't seem to be massive correlation between the price of oil and the price that gets paid at the pump. That has not yet been passed through in any meaningful way. But still a lot again, on talking about positive sound bites, the recent trip to the Middle East has been punctured with many positive sound bites. So I'd say that that's, again, markets digesting that and feeling that it heralds a wave of investment into the US. I'd say, again, the devil is in the detail. Many of these investments could take a decade at least to play out. And equally, we've seen similar commitments around chip factories, Foxconn, for example, and investments in the US, which have still to materialize. So I'd say just investors will be more prudent to perhaps focus on the detail, but show instead of tell. Some other small bits of news just to round up here. Gold continues to be in strong demand as a hedge, as a safety asset. As in many cases, it's always been used as a hedge against debasement of currency. And given we've seen a lot of debasement of currency and potential future debasement, gold continues to be in hot demand. But it is now, according to the fund manager survey, Bank of America, most overvalued on record. So that's, I mean, fund managers would say that, wouldn't they? Given many of them do not hold gold. But it is interesting to say that most consider this recent run has made it most overvalued in 17-year history. And moving to the dollar, interestingly, the rally in the greenback has not matched the rally in US equities. And this has been a divergence that we've spoken about before, because I think it's been the case that US equities have generally been supported by the retail investor, whereas the greenback is a much broader base and would also signal a lack of more confidence in the US. And we've seen that with treasuries as well. And then a final comment on regulation. I haven't got a headline here, but there was a discussion around regulation of drinking water. That seems to be on the point of being rolled back. But equally, some of the bank rules imposed in the wake of the 2008 crisis around capital requirements, seen as being perhaps too stringent. Finally, now the financial institutions that rallied after the Trump election are seeing some of those forecasts come home to roost. So we will see with this trading volume in markets is also likely to bode well for bank earnings. So I'd love to hear, just finally, John, in terms of a comment, holding gold directly, holding Bitcoin, taking a position on the dollar. Are any of these positions that you see clients trying to get in on?
We haven't. We've used gold with some clients in a very, very small way. We have not used Bitcoin or any crypto. At this point, we still instead have recommended that they accept them as a donation rather than actually implement them in the portfolio so that they can open up their donor base.
I like that. Donation of crypto. So that's it for today. Thank you so much, John, for coming and for lending your insights from Clearbrook and beyond. We enjoyed having being in New York City for this podcast and sort of being at the center of some of the action. And look forward to joining you next week. Thanks, everyone.